99% of retail investors don't actually have a portfolio. What they proudly call a portfolio is just a chaotic graveyard of random tickers. They buy stocks because they read a hot news headline, saw an emotional post on Telegram, or simply because a company's logo looked familiar. That is not investing, that is collecting. And when the market plunges into a recession, these collections are the first to burn, leaving the owner with 60 to 80% losses. Today, we are putting an end to the amateur approach forever. I will show you a true, bulletproof institutional architecture, a system that protects your capital in a crisis and aggressively outperforms the index in a bull market. We will break down strict financial filters, the rule of 40, hidden insider trades, and the exact step-by-step algorithm to find rough diamonds using primary SEC filings and the FinViz screener. Grab a notebook and turn off your notifications. This will be the most dense and valuable capital management lecture you will ever hear. Step 1. The toxic filter and sector balance. Before building a skyscraper, you need to clear the construction site of toxic garbage. Our baseline, uncompromising step is this. We completely exclude 4 sectors. No tobacco companies, no alcohol, no gambling. Smart money and trillion-dollar ESG funds are increasingly avoiding them due to regulatory risks and ethical mandates. When institutions stop pouring liquidity into a sector, it turns into a swamp. We need a clean, scalable business that generates real value, not one that survives on human vices and geopolitical conflicts. Next is non-correlation. You cannot just pick perfect companies from a single industry. The ideal circulatory system of your portfolio should be allocated like this: technology and software, our locomotive, cloud computing, cybersecurity. These are companies with the highest profit margins in the world. Healthcare, our defensive fortress. The global population is aging. People will always buy medicine, regardless of interest rates. Financials and fintech, the circulatory system of the economy. Banks and payment gateways earning on global transactions and interest rates. Consumer and industrials, essential retail and companies building physical infrastructure. Also, you can consider energy. This proportion guarantees one thing: while one sector is in a cyclical downturn, the others will pull your balance up. Step 2, level 1, large cap, the unbreakable foundation. The first 40% of your capital is the defensive foundation. This is home to large cap companies with a massive economic moat, global monopolists whose infrastructure the world will use during any crisis. For a company to enter this block, it must pass several strict filters. A positive ROIC to WACC spread. Most people only look at the return on invested capital, ROIC, but that's a mistake. If a company's ROIC is 10%, but its weighted average cost of capital, WACC, is 12%, the company is actually burning money because its debt costs more than it earns. We demand that ROIC be at least 5% higher than WACC. This is the true indicator that a business is generating real wealth. Debt to equity less than 0.5. The survival test. Debt must be less than half of the company's total equity. Over-leveraged giants do not survive tight monetary policy. FCF yield, free cash flow yield, greater than 4%. Accounting profits can be faked on a report. Free cash cannot. This metric tells us exactly how much real, cold, hard cash the company brings in for every dollar invested in its stock. Aggressive share buybacks. We look at shares outstanding. This number must decrease every year. When a company buys and burns its own shares, your ownership stake and your earnings per share automatically increase. This is your hidden dividend. Operating margin greater than 15%. We want a business that keeps a significant portion of its revenue after operational costs, proving it has the power to dictate prices to the entire market. Step 3, level 2, 40% GARP, the engine of excess returns. The next 40% is the engine of your portfolio. Here, we apply the GARP strategy, growth at a reasonable price. We are looking for mid and small cap companies. We strictly avoid microcaps. That is a zone of manipulation and zero liquidity. Our focus is the strong middle class, stocks that are growing aggressively but that the market has, for some reason, priced incredibly cheaply. Here are the indicators to find the perfect asset. PEG ratio less than 1. This is the holy grail of our strategy. The standard PE ratio is blind to the future. PEG compares a company's price to its growth rate. If the PEG is less than 1, you're literally buying a financial Mercedes for the price of a bicycle. You're paying less for growth than it's mathematically worth. The rule of 40, the gold standard for operational efficiency. Add the company's annual revenue growth rate and its free cash flow margin together. If the sum is greater than 40, you are looking at an elite, incredibly efficient business. Zero dilution. Growing companies love to pay their employees in stock options, SBC. If the number of shares outstanding grows by more than 1 or 2% a year, that is hidden inflation. Management is stealing your returns. We need companies that do not dilute shareholder equity. Insider transactions greater than 0%, not executives receiving free options, but actual purchases on the open market. If the CEO and top managers pull out their own hard-earned cash and buy millions of dollars of their own company's stock, they know something Wall Street doesn't. This is a massive signal. Revenue growth greater than 15%. Consistent revenue growth on average over the last 3 to 5 years. The company must not be stagnating. It must be aggressively stealing market share from its competitors. Step 4. Satellites and reserve, 10% and 10%. We split the remaining 20% in half. The first 10% are venture satellites, moonshots, disruptive biotechnology, next generation hardware. They might not have net income right now. The risk is maximum, but just one of these companies doing a 10 times pace for the entire portfolio. We strictly limit this risk to 10%. The final 10% is strategic cash, money sitting in short-term bonds or money market funds. This is your loaded weapon for a black swan event. When the crowd is panic selling assets due to margin calls, you will coldly buy the best businesses in the world at absolute rock bottom. Cash is not missed opportunity. It is the price of an option on future opportunities. Step 5. The financial X-ray, SEC filings and earnings, seasons. Screeners and aggregators only show a pretty cover. You are not buying a ticker, you are buying a real business. And to look under the hood, professionals use primary documentation, reports from the Securities and Exchange Commission, SEC. If a company's investor presentation is a photoshopped social media post, SEC filings are the dry medical records. Lying on a presentation has no consequences. Lying on SEC filings sends a CEO to federal prison. You only need 2 types of documents, the 10K, the deep annual audit, and the 10Q, the brief quarterly summary. Finding them is easy. Just search the company's name and the phrase investor relations, or go to the free Edgar database on sec.gov. The 10K report is massive, but you only need 2 sections. MD&A, management's discussion and analysis. Here, management is legally obligated to explain in plain English why revenue dropped, where debt came from, and what real problems the business is facing right now. Risk factors. This lists every threat that could kill the company. Read this, and you will know more about the business than 90% of analysts on the internet. And the ultimate test is earnings. 4 times a year, a company reports to the market. Beginners look at whether the company beat revenue and EPS forecasts. But the stock market lives in the future. Past profits are already priced in. The only thing smart money cares about is guidance. If the current report is perfect, but on the call, the CEO announces lowered guidance for the next quarter, institutions instantly dump the asset and the stock falls off a cliff. That is why we never buy stocks the day before an earnings report. That's playing roulette. We wait for the publication, listen to the guidance, confirm the fundamentals aren't broken, and only then do we enter the trade. Step 6. Practice the Finviz guide. How do you physically find these stocks in a sea of financial garbage in just 2 minutes? we use the free screener finviz.com. Open the site and go to the screener tab. Our goal is to filter out 8,000 stocks and leave 20 ideal candidates for our GARP block. First, the descriptive tab. Market cap, select plus small, over $300 million. We cut out all illiquid garbage. Industry, exclude toxic industries, selecting only our target sectors. Next, the fundamental tab. PEG, select under 1. The market instantly cuts out all the overpriced hype. EPS growth next 5 years, set to over 15%. We only keep those planning to grow aggressively. Debt/equity, set under 0.5. We remove potential bankruptcies. Insider transactions, select positive greater than 0%. Institutional ownership, set over 50%. We ensure smart money is already sitting in this asset. Look at the results. Out of thousands of companies, you are left with 15 to 20 tickers. This is your golden shortlist. You just did the work that Wall Street analysts get paid hundreds of thousands of dollars to do. Step 7. Smart money and the staircase strategy. You have the perfect stock, but hitting the buy all button right now is financial suicide. A perfect company bought at the wrong price becomes a losing investment. We apply smart money concepts. Large players cannot buy an asset invisibly. They form order blocks, consolidation zones on the chart where algorithms accumulated positions in the past. Price always returns to these liquidity pools. We open the chart and wait patiently, and when the price falls into this zone, we apply the staircase strategy 30-40-30. We divide our budget for one specific stock into 3 parts. 30%, the scout. We enter at the upper boundary of the order block. If the price instantly flies up, we are already in the market and making money. We completely eliminate the fear of missing out. FOMO. 40%, the core. If panic continues and the price drops deeper into the liquidity zone, our second order triggers. We grab the lion's share at a massive discount, lowering our average entry price. 30%, the deep reserve. This is a limit order at the absolute bottom of a strong support level. It triggers rarely, but during true market hysteria, you get the asset for pennies, mathematically guaranteeing yourself massive returns on the bounce. Finale, your action plan. Portfolio architecture is not a collection of pretty logos. It is a cold, calculated system. You cut out toxic industries. You allocate risks. 40% in impenetrable fortresses, 40% in undervalued GARP growth, 10% in venture, and 10% in cash. You demand a perfect ROIC to WACC spread, strict adherence to the rule of 40, zero share dilution, and you read SEC filings to know the truth. And then you enter the trade like a sniper, using a staircase approach in institutional liquidity zones. Invest in your knowledge, because in the stock market, money always flows from the impatient and lazy to the systematic and disciplined. In the next video, I will take one specific ticker from our FinViz screener and do a full breakdown, from the lines on its balance sheet to the perfect order block on the chart. Subscribe to the channel and implement this system into your finances today. Manage your capital wisely.